Let's talk about bond with default risk. Previously, we assumed that the cash flow promised at the bond issuance, the investor will get it for sure without any issue. But in real practice, even the government could fail to pay what they promised. So what is default risk definition? Default risk is the chance that a bond issuer, University of Manchester or government, fail to make any scheduled payment, coupon or principal or face value. If this happens, we're going to call that as a default situations. So we have been observing big default by the Argentina or some big company like Lehman Brothers. We have to take into account default risk when we price bonds. And how do we measure it? One common measure is going to be using credit rating assigned by credit rating agency like S&P or Moody's. Why this rating matters? Because if someone says our bond is rated at triple A or triple B or below that, your requested yield will be different. You will ask bigger yield to maturity, or in other words, bigger discount rate for more riskier project. You want to discount more about the future value if that value is very uncertain or risky. So this is the example of bond rating done by Moody's and S&P. They give triple A for the bond they think that with the minimal default risk. And in their so-called the speculative bond or junk bond, it's below triple B, so it's a BA or BB, BB in S&P case, BA in Moody's case. Below this BBB rank, we call this a junk bond. It's very risky. You shouldn't assume you're gonna get the promised cash flow in the future. You have to ask more premium for yield to maturity if you try to hold these kind of things. Now, in real practice, we can construct the zero coupon bond for different credit ratings. So blue one is the zero curve. US Treasury yield curve, yield to maturity are very low. And for other credit rating like triple A, triple B, or B like a junk bond, you see the whole different level of yield to maturity. So especially for PBB case, the difference is we call this difference as default risk premium. The investor ask for the buying more riskier one. So if you buy junk bond, you will ask really big yield to maturity for that. Now, we have to be careful about one thing. When we talk about this yield to maturity, is actually the promised yield to maturity. What is the meaning of that? When we compute yield to maturity, we always assume that it's an internal rate of return. We always assume that you will get all the cash flow. So we assume there's no default risk. It's called promised yield. If the bond issuer really pay everything they promised, I should call the best scenario case. The best scenario case, bond issuer pay everything, every coupon and face value to you without any issue. Under that situations, you compute the discount rate where NPV is equal to 0. That's the yield to maturity you're going to get. You compute that based on the promised cash flow in the future, not the actual cash flow or not the expected cash flow. Let's talk about that using an example. Using this example will make you understand more about this concept. Let's say assume 1 year default free zero coupon treasury bill offer the 4% yield to maturity, 4% discount rate. Now, following 3 1-year zero coupon bond with a face value of $1,000, these 3 bonds will issued by Avant. Then these 3 bonds will differ only with respect to their default risk. So case 1, let's assume there is no default risk whatsoever. So assume all investors agree Avant will not default. Then this bond is basically risk-free. So you need to treat this one as something like treasury bond, the bond issued by government. So what you ask, the per period return should be same as the risk-free rate. The price is going to be the 1,000 you're going to get after 1 year, the face value, divided by 1 plus discount rate, the 4%. So today's price is going to be 961.54. So what is the return you're gonna get? So how do we compute return? Returns, so what you're gonna get eventually minus what you paid initially. What you're gonna get eventually minus what you paid initially. you get the return of 4%, the same as yield to maturity. So in this sense, the yield to maturity can be interpreted as the per period, in this case, 1 year return. Now let's talk about certain default case. So assume that all investors know a bond will default. They will not pay the face value after 1 year. They're gonna pay only $900. This one is given for sure. So we can still treat this bond as a risk-free. So a little bit weird, but still there is no risk involved with this cash flow. And discount rate is still 4%. What is the difference? Difference is now we know that the actual cash flow you're gonna get is 900, not 1,000. So when you compute price, the present value of future cash flow, you need to use this 900 as the future cash flow you're gonna get. So what is the discount rate? So because this is also risk-free, you're gonna use the first 4% discount rate here. So the price you're gonna pay is the present value of what you're gonna get is the $865.38. Now, what is the yield to maturity for this bond? We just use the yield to maturity for risk-free bond. What is the yield to maturity for this bond? Remember, yield to maturity assume the bond pay all scheduled interest and principal the face value at the end, and you hold the bond to the maturity. So even if default is certain, yield to maturity, you need to use the promised payoff face value in your computations. So yield to maturity in this case, we use the formula where you get yield to maturity based on the zero coupon price. Then the face value divided by present value minus 1, you get the 15.56% yield to maturity. If you're not sure about this one, just do the usual cash flow diagram things. Today's price is $865.38. This we want to compute yield to maturity for this period. So the present value of this thing using this one should be equal to this. Based on that formula, we can back out the yield to maturity for this bond. Anyway, the yield to maturity bond is 15.56%. This is the yield we saw in the zero coupon yield curve for defaultable bond. It's based on the promised cash flow. So we call this as a promised yield, or I should say best scenario return. If default doesn't happen, you will get this one as a return. But what is your expected returns? So what is the expected return? You're going to compute what you're going to get minus what you initially pay. So it's going to be 4%. Though, in this case, it's also risk-free case. What you're going to get is the yield to maturity for the similar zero coupon bond. The promised yield is going to be completely different because this is based on the best case scenario. This is very important. Now let's talk about more realistic case called risk of default case. Assume that bond payoff are uncertain, so you're not sure. So there's a 50% of getting $1,000 and 50% chance of getting $900. So what is your expectation? So the expected value of this one is the 1,000 times 50% 0.5 plus 900 times 0.5. So the expected value is 950. So you expect to get this one. Now when you compute the price for this thing, you need to get present value of this one. Now, should be the discount rate? In the risk-free bond case, the yield to maturity, the discount rate for the risk-free bond was 4%. Now, because the future cash flow is uncertain, you want to ask some premium for buying these bonds. In other words, you're going to ask certain premium over that. So what is the risk premium? Let's say the risk premium is given to you as a 1.1%. So discount rate should be risk-free 4% plus 1.1%, so 5.1%. Then by using the expected cash flow and then your discount rate, the current price will be 903.90. Now, given this price, we can still compute the yield to maturity for the best scenario case. Best scenario case, you're gonna get face value. What you pay is today's price. So again, you get this yield to maturity by saying this. So you get $1,000 after 1 year. Today you pay 903.90. What is the discount rate you can use right here to get 903.90 for $1,000 in the future? So yield to maturity is a 10.63%. What is the expected returns? You're paying 903.90 today, so this is what you pay. What you expect to get is 950. So the 5.1% is your expected returns. So your discount rate is actually your return, right? And the promised yield is going to be the best case scenario returns where you get the 1,000 for sure. So based on this example, what we can say is that bond expected returns like a 5.1% will be less than the yield to maturity, in this case 10.63%, if there is a risk of default. Compared with the certain default case, well, let's talk about this one by looking at next table. So let's summarize the three different case, three different bond price, three different yield to maturity, three different expected returns. If you compare this one and this one, bond price decrease, yield to maturity increase, but what you can say is that higher yield to maturity for certain default case doesn't guarantee you to get the higher expected returns. You get higher expected return for risky situations. You get less than 5.1% for less uncertain case. Even though promised yield is biggest here, expected return is biggest for uncertainty case. So once you study this bond with default risk, I'm asking you to try solving this poll question. So here we're gonna value coupon bond with default risk. The Luda industry needs to raise $25 million to fund a new office complex. The face value is going to be $1,000. Coupon rate is 7%. Then we have this yield to maturity for similar 10-year corporate bond. Assuming that Luda's bond receive a AAA rating. So once the credit rating is given by S&P or Moody's, then we have to use that yield to maturity as a discount rate for discounting all future cash flow promised by this Luda industry. So given AAA rating, you should use 6.7% as a discount rate for getting present value of this thing or price of these things. So try solving this one in your home.